Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming to the Market Chameleon pre-market show, led by myself, Will McBride. And there he is, the King Chameleon. He just turned off his video, Dimitri Bargamani.
Hey, Will, how's it going,
buddy? You want to
Pretty
start
good.
with a disclaimer?
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not a broker dealer, and we're not telling you what to do. We're just sharing ideas. If you want professional advice, call your broker or your registered investment advisor. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer. And
all right, what's going on in the pre-market? More volatility?
Yeah, let's take a look. And, before I get started, we'll do, Q&A. We open it up for questions. So if you guys have any questions regarding Market Chameleon tools, data, analytics, strategies, you want to come on, you could ask your question on the live chat. We'll monitor him. He'll read them back to me. Or if you want to come on the show and ask it live, we put out a link to Zoom. You click on it, go over to Zoom, raise your hand. You don't have to turn on your video camera, but you could ask your question this way directly. And the idea behind it is, look, we could talk about tools and data, but trading involves education and experience. And that's what the key, right? The most important part of it. And this is a way to share your experiences, things that might be working for you, maybe things that didn't work the way you were expecting, but you could come on a show, kind of discuss it, and it benefits the entire community. So while we're waiting for any questions to queue up, I'll start going over the pre-market report. Maybe I'll go to the unusual option volume. We had some outstanding questions. Well, you said yesterday, so I'll try to go back and answer that question, and then we'll just move on from there. So this is the pre-market report, and these are stocks that are trading in a pre-market hours. We have a list of the most active stocks, biggest percentage gainers, biggest percentage decliners. If I scroll down here real quick, I see 142 stocks made our percentage gainers list, 56 on a percentage decliners list. So from this perspective, looks like we're setting up for more bullish bias at the open. I'm going to filter this list. Let's take a look at the S&P 500 stocks to see if we see a similar situation there. So by going up here, I could use these filters to narrow down this list. So I'm going to use an ETF. I'm going to drop it down by selecting SPY. This is going to filter the list by the S&P 500 components. And hold on, I got to refresh here. And let's take a look at SPY, S&P 500 components. So we have 31 stocks that made the percentage gainers list, 11 on the decliners list. So almost 3-to-1 ratio there, favoring the bullish side of things. So it looks like right now, we're setting up for a higher open. One thing maybe I'll take a look at, there are a lot of earnings. A lot of these are earnings related. So as you can see here, a lot of these E's here are representing that the earnings was either announced yesterday after market close or today before the market opened. They started announcing earnings, and some of these are reacting to that earnings announcement. And if you wanted to narrow down that list, if you click on here as earnings, now we could see the stocks that are moving in S&P 500 reported earnings. 8 are up, 7 are down. So almost even there. Let's take a look before I move on. Since we've been pretty volatile these, I don't know, last week or 2 weeks, let's take a look at what happened in general to the pre-market movers, stocks that were gapping in the morning. What tended to happen after the opening during the regular market session? Was there a follow through, or did they give back their gains or recover from their losses? what tended to happen after the opening. So the question really is, did these pre-market moves, were they an indicator of a follow through, or was it an overreaction? Did it tend to overreact or overshoot in the pre-market? Okay, so let's see if we could get some insights on that. So I'm going to come down here. So I got more reports, and this is looking back at the data for the last 20 trading days, and it's got the pre-market movers listed out here. Okay, so this is by most recent. So this is yesterday's, and if you go back, you can see 2,000 stocks here moved into pre-market, and this is to the upside, gapped up, and then we have a report gaps down. So if we take a look at all of the stocks, right, all of the stocks, 2,000 observations the last 20 days, stocks that gapped up, opened higher, they're trading in pre-market, opened higher. What happened to those stocks the rest of the day? And here are the stats, and we look at it from two perspectives. One is from the opening, what happened in the first half hour? Was there a follow through? If they opened higher, was there more pressure to the upside? Did that indicate that there was more buyers coming in and push the stock even higher? Or was that an opportunity to say, hey, that those moves in the pre-market were overzealous, and it was an opportunity to get out? So by 10 a.m., this is what tended to happen. From the opening, in the first half hour of trading, by 10 a.m., 53% of those stocks continued higher, right? So they opened up higher, and this is how you would look at it. You could see here something like this. Here's an example, Qualcomm. It opened higher, opening price 168.04. That was 1.6% higher from the previous day. At 10 a.m., the stock was 171.03, so it gained an additional 1.8%, right? So this opened higher and continued higher by 10 a.m. So what happened the rest of the day, right? So you still have a full day of trading. Then things calm down. You got your VWAPs kicking in. You got all, more and more participants kind of coming in. Maybe that initial, reaction is kind of over. What happened the rest of the day. And here we see in Qualcomm, it actually ended up down from that opening price, right? So from 168.04, by the end of the day, it couldn't hold that opening price, was down on the day. I'm sorry, not down on the day, down from that opening price to 167. So that's just an example of, now we're doing that stat on the whole group. So what happened to the whole group? 53% of them continued higher for the first half hour, just like here, Qualcomm. But by the end of the day, only 37% finished higher than the open. 62% were lower from the opening price, just like here, just like Qualcomm here. This is what tended to happen for those pre-market movers that gapped higher. So what this is telling here is that even though we open higher, and whatever the news was, and right now we're volatile, from the open, the markets tended to sell back off from that opening price. Let's take a look at maybe S&P 500, because this is all the stocks in there. So we could have low cap, biotechs, all the stocks in there. So let's focus just on the S&P 500 stocks. So I'm going to use this filter here, and I'm going to say, what about stocks in the S&P 500, SPY? So these are all the stocks still up here now we got the S&P 500. So 345 observations in the last 20 trading days. And this is what happened to this group. 51% continued higher, 48% went lower that first half hour. So not, close to this, maybe not as good, but close. By the end of the day, 39% were higher, 61% were lower from that opening price. So similar, maybe not, not as bad percentage-wise. This tended to lose 1.3% on average, this 0.6%, but similar situation here. So what we had is tended to reverse, right? Anything open higher, 61%, reversed from that opening price. Okay, so we're using the opening price as our benchmark at that point. What about the gap down? So let's take a look at this scenario. So same thing, I still have my filter SPY. That's why you see two of them. So stocks that gap down, 38% of them from the opening price rallied, 62% were lower. So what it's saying is that those that gap down, a lot of them, 62% of them continued lower in that first half hour, right? So there was a follow through to the downside. But by the end of the day, it looks like they reversed from the opening price, and 55% of them were higher than the opening price, 44% lower, for an average gain of the 0.5%. So it's almost the contrarian, right? The contrarian by the end of the day tended to work better. Does that make sense? Here, the contrarian opened higher, tended to move back down, opened lower, tended to move back up from that opening price, right? So not from the previous day, but from the opening price. What about, right?
We did have a question from Trevor, and there's a little bit of a delay, so you may have mentioned it a little earlier about VWAP. He's asking, can you explain VWAP and what it is actually telling you?
Yeah. All right, so we'll go to VWAP, but just quickly, just to finish this up, S&P 500, this is because I'm using this filter. These are the S&P 500. A little kind of similar situation there. The ones that were lower, first half hour, continue. The majority of them, 63%, tended to move, down even further from the opening price. But by the end of the day, it looks like those they reversed from the opening price and tended to close higher, 61% of the time, for an average gain of 0.9%. So in this, at least from this sample, right, we're taking as a whole group, it was the contrarian work better, 61%. All right.
Hey, we have a question about the length of days in the observation. Is there any way to change that? If not, why do you just do 20 days?
So here, what we do is try to look at what's going on in the most recent history, right? So what's going on, and things are changing as you go, right? So we're looking at the most recent data and what's happening now. So things that were maybe trading 2 or 3 months ago might not be as relevant, today, because there's news, there's different volume, people are behaving differently. So we're trying to see, in essence, looking at the most recent data, the recent volatility, the recent, headline news, what are people tending to do? So that's why so maybe if I go back 1 year from now, it might be completely irrelevant now to what's going on today, right? Like if I go back to the coronavirus or go back to the internet, it's not as relevant as it is today. So why 20 days? We just picked that that the 20 days is like a month's worth, right? Because these are 20 trading days. So that's kind of where we picked as the most relevant data to today, right? You could pick lower, you could pick higher, but that's how you pick a number, and we kind of just stuck with that 20 days.
Because if you, I mean, you're mostly looking at you're looking at the S&P, so it's like looking at the whole market. How is the market reacting in the last 20 days rather than 6 months ago? Because things have changed, and you want to understand just what's going on. I mean, if you want to look at each individual one and how they've responded in the pre-market, you can go do that data, right? We have those data sets.
Yeah, exactly. You could go to each individual one, like, you could go to Apple, and I think here, pre-market, historical gap move, you could, here you have a much more granular. You even have here minute by minute, right? VWAPs that you could go back, download the data, and look at it this way. I mean, I'm not sure how far back that's also till December. So really the most recent, this is what we have available right now. We don't go back. And it's also, a lot of people will give me 10 years data, give me 5 years data. And there is a balance with how much data you could query, because as you're going back, as you're adding more data, it's more taxing on the entire system. So it's like, do you add more relevant data now? Or, as you're going back further in time, you're adding more and more data, which takes more and more capacity. It's adding costs, right? So we're trying to make it as cost effective as we can for everybody, right? Because otherwise we'll have to pass on that cost, right? So if you're at it, go from 20 days to 200 or 300 days, then we have to either, add the cost of servicing that and servers and people querying. The problem is that when you go back that far, you might have maybe 1 out of 1,000 users once a month query it, but to the cost, it's probably quadrupling the cost of maintaining it. So that's why we're always balancing that out. If we had a lot of users looking for that, of course, then we would consider that. But if you have like 1 out of 1,000 users saying, I want to go back 15 years, but to do that, we'd have to add the cost to all our users. It wouldn't be fair and make sense. Does that kind of make sense? So that how that works?
Yeah.
All right. So remember, like because what's happening is the data itself, it's stored, it's in a warehouse, and you're querying it. The more querying you do, the further back there's a cost to it. So again, this is how it, right? The most recent 20 days, but you have a history of gaps anyway for a stock, right? In Apple, because here, you have opening, so you could download years of history to look at the opening gap, right? So that opening gap, you could go back and download, and you have years of history for that to analyze. Make sense?
Yeah, perfect.
Okay. So let me take a and by the way, I think we actually added even here to the years of history. I think we added even notes, if there's an expiration, right? Let me see if you download this. If there's an earnings, we added notes, company event. So you actually, in this download, get pretty good. You could go in there and actually just look at the earnings, or look at where there's a company event, or analyze, prior to expiration, after expiration. So you do have a lot of, and this is I think this goes back years of data. If you download it goes back years. So you do have a lot of data to work with.
Yeah, I mean, and I'm looking at the individual stocks in the pre-market. You click on them, you can get gap up history, gap down history that goes back,
Yeah,
years. So there's plenty of places to get the history.
You have all these analytics. That's what we try to do. The analytics. It's the raw data. With the raw data, with all the prices, and that's the issue. When you have not summarized data, but raw data, there's a lot of it. So let me see. Was there another question on the pre-market? Well,
Nope.
let me go to unusual option volume. I think there was a question here.
Yeah, I think that was a Trevor. Trevor left that question. I didn't catch it yesterday about the percentage change, what it means when it's negative.
So, right. So here, just to recap, this is the unusual option volume report, and it's a list of stocks. We have the option volume on a day. We compare that to average daily option volume. And when we take that ratio, I think if it's about 1.9, it makes this report. Okay. And there are two, we broke them up into sections. Here's option volume statistics. We break it down by notional value traded on the calls and puts. And then what did the stock price do? So this change is just looking at on the day, was the stock up or down? That's what this is looking at. So it's just telling you, okay, there is unusual option volume. What is the stock doing? It's up on a day. So it just gives you an idea of what's going on in the stock, in the related stock. There's another percentage change. We talked about the catalyst events on the implied volatility. So this is the option implied volatility, the 30 IV. And this is the change in the IV from the previous day. So when it's up, when the implied volatility is up, that means that the option premiums are moving higher. Implied volatility is moving higher, option premiums are moving higher. And the takeaway is that the way people are betting is that the future stock move, they're betting that the stock moves in the future will be greater, right? When you're pushing premiums higher, you're saying that the movement in the stock is going to be greater going into the future. And that's where these are the percentages. If they're going down, right? If they're going down, then the forecast is that they're looking at the future stock moves, right, to be not as great as the day before. So besides these percentage change, we do put in IV percentile rank. An IV percentile rank is also telling you that if we look at today's implied volatility, the 30-day constant maturity implied volatility, we want to know how, for this particular stock, how high or low is it, right? In general, is it high or is it low? Because for some stocks, 145 volatility might be normal. For SPY, that would be like a ridiculously high. I don't think it even gets there. So for each particular stock, we need to kind of take a look at and say, okay, we know on a day when up or down, but is this implied volatility high or low? And that's where we come in with the IV rank. And what the IV rank does is say, if I go back 1 year, 252 trading days, and I look at the closing implied volatility, right, and compare it to the last 252 days, what percentage of the days did it close lower? Okay. The percentage of the days it closed lower was 94%. Meaning 6% of the days in the last year, it closed higher, 94% it was lower. So this gives you a sense of is the current implied volatility high or is it low relative to how it's been trading the last 252 days? So hopefully, Trevor, that helps answer the question, because I only see two places where you see percent change, this one and this one. And let me know if there's a follow-up on that one.
Yeah, Trevor, hopefully that helps. He did have another question, not so much about unusual option volume, but he's asking, where on the site can I find stocks with, and maybe it is here, I don't know, but more put buyers than calls, like an abnormal amount of put buyers relative to calls. Is there any place you can screen for
that? More put buying than call buying?
Yeah.
Without moving from this screen, I mean, I could just sort this really quickly just to see, you know, in volume terms, you know, where, you know, I could just compare it here, the notional amount of puts versus calls. Let me think where there's more put buying. I'm sure there is.
Alex is actually saying option order flow. Option order
flow settlement, right? Or maybe let me just take a look at the options volume. Right. So on the options volume report, I think we have here. Let me just see real quick. I do it in percentage. Okay. So just really quick here on the options volume report, we do have the percentage of puts that were traded versus the percentage of calls. So you can kind of just sort it right here just to see where there a big percentage of puts were. But you would have to go there and just then go to this individual stock and see where, you know, what traded. Let me see if these are. I'll have to. I'll come back to that tomorrow. I have to find. You know, I forgive myself now where that lives. I think we do have it, but I have to figure out where that lives.
Well, we have a screener under options, option volumes, and there you can search for high call, high put volumes. So there are a lot of places to.
Yeah.
And you can search by percent.
Right. So what I think though is Trevor's asking perhaps is, where is there an overwhelming amount of short betting versus long betting, right? Where are people leaning short, where are people leaning long? And you could do that several ways: buying puts. You could do that buying put spreads, debit spreads, selling call spreads, selling calls. And that is something, it's interesting he asked, because that's something I am working on. And that, I think you guys are going to like it, you know, but I am working on it. I don't have it on here now to show you guys. I don't have it on here now. I have it on my other test environment, but I'm going to try to see if I can bring it on here and show you guys where we actually show how that order flow is moving throughout the day, and the magnitude of bullish versus bearish betting. And we kind of even break it down by trader size type, if it's small retail, professional, or a large institution. So I've been working on it for a while. You know, I didn't even want to bring it up because I think once I bring it up, people start emailing me like, when is this coming out? But we're getting close. So I'm going to see if I could put this on, and, you know, it's on my test environment, but I'll show you guys what I mean.
All right. Well, that's a treat for tomorrow. Nice job, Dima.
Thanks everyone for joining. We're right up at 9:30. I hope you guys have a great day, great trading day. Stay safe out there, and we hope to see you guys tomorrow.
Yeah, great job, D. Everyone, we do have a webinar with Jake at 3 p.m. Jake will be on with me, and it will be a great show. I put the link in the chat. D, awesome job as always. Chameleons, it's all about you. Thanks for joining us today.